Welcome back. You're watching us here on Chartbusters. We've spoken about the secondary markets, but let's talk about the primary markets because now we have an IPO opening up. Non-banking finance company SBFC Finance. The company has launched their 1,000 crore IPO today. The subscription will be open for public till the 7th of August itself. Aseem Dhru, who is the MD and CEO, as well as Mahesh Dayani, who is the Chief Business Officer, both of them joining us in our studios to talk about their business itself. Thank you so much, gentlemen, for joining in. Always a pleasure having you.
Thank you.
Just wanted to understand, this 1,000 crore rupees that you're raising in terms of an IPO, what does it do to your overall capitalization and how much does it help you for growth going forward?
So the capital adequacy currently is 31%. Post the IPO, that moves up to 41%. We feel that's going to last us for another 3 to 4 years, considering the growth that we've done over the last 5 to 6 years. We've grown at roughly around more than 40% on a CAGR basis. So considering the overall growth momentum that's there in the industry and our current growth pattern, we feel that the current capital raise is going to last for another 3 to 4 years.
All right. Hi, good morning, gentlemen. Thanks so much for coming down to the studio. Well, big moment, right, for y'all. So, once your list, then we'll get further numbers. But just want to ask you all, this growth that you're talking about, it's been quite good. So can you sustain this momentum? And also, how do you all differentiate yourselves from the other lenders that are out there? There's plenty of options, right? But there must be some niche. Go ahead.
So if you look at the overall market, I think the entire MSME market is a fairly large market. And, we're trying to solve a very difficult problem. So, there are too many reports floating about the large credit size and the unmet credit demand which is there. But if you were to just look at the bureau numbers, the bureau numbers tell you that the secured MSME market is close to around 8.5 lakh crores, growing at 17-18%, which practically means that the market's actually doubling every 4 years.
Right.
Within that, SBFC's carved out a niche saying that, it's the total market is 2.5 lakh crores, growing at 24%, which effectively means that you double every 3 years. So there's a possibility that the market doubles in 3 years. So there's a good runway for growth there. And when you look at a space between 5 to 30 lakhs, you're really creating a niche for yourselves because banks have moved into a significantly larger prime market, larger ticket size, leaving this space for a lot of NBFCs. Right. So I think it's a good place for the NBFCs to be there, serving the small in the MSME space.
You found your niche. You've been growing at 40%, and by the looks of what you're saying and the capital that you're raising, you're likely to continue that growth as well. But that's one part of the business. The other part of the business is recovering that money. I mean, 6% of your book currently is in moratorium, which is on the higher side. We're also looking at, a lot of people not repaying back, especially in that ticket size that you're speaking about.
No, so a clarification here. 6% is not in moratorium. 6% had availed of moratorium during the COVID period. After that, since the last March, it's on a normal cycle. And it's a routine portfolio. It is just that as a disclosure, we are putting out that this is the portfolio that had availed of the moratorium.
So let's put it this way. What are your internal metrics of credit cost and NPAs every year and recoveries and slippages?
So just to add on the 6%, 5% is a paying portfolio.
Right.
Within that, 85% of the customers are current, which means that there's not even a single rupee delay on that. So moratorium, I think, was great. It just helped the MSME segment to get back on track, and I think it's a fantastic paying portfolio. From a risk perspective, from an overall delinquency perspective, if you look at this particular market, the gross NPAs in the market is close to around 4.2. We are close to at 2.4, which is practically half of what the industry is. The aspiration is that probably we maintain a credit cost of anything between 75 to 100 basis points. We're pretty much within that particular range.
Cost of borrowing would have gone up, right, in the last few months. Could you tell us what was the cost of borrowing? Where do you see that stabilize? I'm just trying to get a ballpark picture. What does it mean for your NIMs?
So repo has gone up by 2.5% over the last 1 year.
Yeah.
And banks have generally passed on about 1.8% as MCLR increase. So our cost of funds has moved up by 1.8%. The entire portfolio we have is all floating rate. So effectively, whatever we have got has been passed on.
All right.
The spreads of 7% that we have has been protected all through the journey.
So NIMs sustain at around this 9.5%?
That's right. That's
right. What about, valuations? I'm looking at a company, the growth is extremely high. You've been diluting capital over the last, couple of years, as the nature of the business would require you to raise funds. So you've been offered a 2.5 times book. Do you think you've left enough value on the table for people who want to enter at the IPO itself? It's a lot of banks are trading at lower valuations.
So see, on valuation specific, we cannot comment, but I will tell you the logic that we have used to arrive at it.
Got it.
What we have done is that we have looked at what is the peer benchmarking, and generally because of a higher rate of growth on a smaller base, you generally have small NBFCs like us, typically trading at a higher book multiple, considering that the growth rate is much faster than what it would be in a large bank portfolio. The second is that we actually did a large pre-IPO and secondary to get a discovered pricing. So we almost did 430 crores of secondary and 150 crores of primary before going into the IPO. And the discovered pricing with these institutions, which are of high caliber, is between 55 to 57 rupees a share at which these transactions have happened. So we have going in with the same band of a discovered price of 54 to 57.
And the promoters being private equity owners, I mean, is there a risk of them, having to exit at some point in time?
The good thing is that our principal promoter, Claremont, is a family office. It's not a private equity. So we are more like an operating company of the Claremont Group, rather than a private equity-backed company. That was something we very did by design, because we are a business that takes debt on rent. If we also take equity on rent, it makes it doubly dangerous.
And 70% of your book is concentrated in like 4 or 5, maybe 6 states at best.
Yes.
Is there anything you're doing to diversify that concentration risk?
So I guess, in the early part of the journey, you'd like to probably focus on the select states. A lot of states that you probably see have the ones where the distribution has come up in the last couple of years. So moving forward, you would probably see them also moving into double digits.
And do we see further improvement in your ROEs? I mean, 12% is...
That's a forward-looking statement. We don't want to fall into that.
We'll catch you when you're list then. But thanks so much, gentlemen, for coming down to the studios and giving us a brief idea about business. All the best with regard to this IPO. And we look forward to having a chat with you.
Yes,
on
thank
the
you.
of listing as
Thank you.
well.
Thanks a lot, gentlemen, for joining in.
Well, for the time.